Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week. Okay guys, hey, it's Imran from Options Insight. Welcome back to Macro Insight. Today is the 22nd of December, and let's have a look at markets. We've had, obviously, over the weekend, we had quite a move. We had been talking about, so last week I'd been talking about how, it had been feeling like the market had been priced for perfection. I was expecting some kind of correction, but I felt from the price action that I'd been seeing that there was reasonable chance that the gamma in the market that was due to the fact there was a lot of options expiring last Friday, it seemed that the dealer gamma in the market was making it hard for the market to move, basically. And so it was only after that gamma disappeared that you might see some volatility if there was the news flow that warranted that volatility, basically. Okay. And then as it transpired, we got a bit of news flow, right? So over the weekend, we had the UK escalate their restrictions on COVID due to a mutant variant of the virus. So they introduced a tier 4 lockdown in London and the Southeast. And they also backtracked on their sort of Christmas bubbles that they were going to allow people to mix with like 3 households or whatever. They went back on that and said you can't mix with anyone, basically. So pretty strict lockdown for London, triggered by this sort of virulent spread of this second strain of the virus that they think is kind of getting out of control. The exact words of Hancock, the UK Health Secretary, were, "This is getting out of control." And we're talking about potential high-level restrictions being in place for a while now until we get enough rollouts of the vaccines. And then the vaccines obviously need to be tested against the new variant of the virus, right? Which is going on. So you've got Pfizer and Moderna testing against this next strain. Now that update on that testing is going to be very important, right? And market's going to watch that closely, because if the vaccines get rendered redundant against the second strain, then all of that repricing of risk that we saw post the vaccine news at the start of November starts to look like it might have to get unwound. And then you can have quite a big move in travel and leisure stocks. That value growth rotation that we saw, some of that could get unwound and it could be a bit of a mess, basically, right? Now, even if you don't get the vaccines, are redundant and they do manage to have a decent success rate against the new virus strain, you still got the fact that restrictions have become more stringent, are likely to last for longer, and you're going to see a major hit on GDP, right? There was clearly a hit on GDP being priced around Christmas anyway, but that might extend to a large part of Q1, which maybe the market hasn't priced yet. So that was the reason why markets were weak. And you also had, you had Europe particularly weak, right? You had the German DAX, if I bring that up, from high to low, from Friday high to yesterday's lows. I think it was about a 4% sell-off, or maybe even more, right? So you had, on Friday, it touched highs into its expiry around, sometime in the morning, it was around 13,750, and it hit lows of 13,050, right? So that's a good 700 point sell-off in the DAX. It's pretty dramatic, right? So, you're looking at best part of 5% sell-off there. Now, you also got a very violent reaction off that. You got a decent bounce off that. That's the DAX. You got that bounce similar. You got a nice bounce off the US. Same sort of story. US sold off, bounced, nearly recovered, pretty much recovered most of those losses. What triggered the recovery? Well, mainly it was the US stimulus. So Congress finally, true to form, when they're gun to their head, that's when they get stuff done, right? So you had Congress managed to pass a $900 billion relief package that included $600 direct payments, $300 unemployment benefit, and small business assistance, the various things that the market kind of needed for a bit of reassurance. Now, it wasn't as if that package wasn't already priced into the markets. Arguably, that was partly why the market had been quite strong into the back end of last week, because the talk was that some sort of 900 billion package was going to get passed. And this was just a confirmation of it getting passed. So was it really a great reason why the market should rip straight back and nearly recover the whole sell-off over the weekend? Debatable, right? But clearly the buy the dip mentality is still alive and well. And any dips that are coming, if you're getting any positive news flow or any kind of accommodation or support from the central planners, let's say, then you're getting those dips bought relatively quick. Yeah, it may well just be the algos that are basically buying on the news of the stimulus, and then that starts to kind of snowball, and then the market just finds itself recovering again. Okay. On the stimulus front, you've also got the Georgia runoff elections on the 5th of Jan. And if the Dems win that, then that probably signals a higher probability of more stimulus coming in Q1 if needed. And they'll find it easier to pass that as well, right? So going to be interesting to see on the 5th of Jan what that result is, because that's going to give us a better idea of how easy it will be to get more stimulus through early next year, because the odds are there will be a need for it, right? If you look at what the trajectory of the virus and the economic situation, I suspect they're going to need some more support. Yeah. So that's kind of equities. That's kind of where we are. What have I done around my positioning in equities? Well, I used that sell-off yesterday as an opportunity to buy back some call spreads that I was short in S&P. So, I'm still running long some DAX put spreads that expire in January, because I still feel like I want some protection against where this market is and how it's being priced. But in terms of the upside, I was able to cash in a reasonable amount of my call spread premium. So I took those off because I'm very aware of how squeezy this market can get. And the fact that it managed to bounce all the way back to 3,700 in less than a day kind of vindicates that action of buying back those call spreads, right? So kind of glad I did that. And like I say, I'm not in a rush to get out of my put spreads in the DAX, because they're not till middle of Jan expiry. And that gives us plenty of time. If this correction wants to turn into something, then that gives me plenty of time to kind of let that play out and maybe take profit or roll my protection a bit later on, maybe in early Jan. Yeah, so that's what I'm looking at in equities. So then if we look over to the FX space, obviously the couple of big things there are the dollar. So dollar, took out 90 in DXY last week, and it got pretty oversold. So it got as low as kind of 89, 70, something like DXY. It did manage to bounce. Generally when you get risk off sentiment, that comes hand in hand with dollar rallying. So if you look at these Bollinger Bands, we were tracking on the low end of it. We literally just touched the average there, and then we faded back again, basically, right? So yes, we had a bounce from oversold levels in the DXY. Arguably, we've done enough that we touched back to the average and then came off again. If we go back down and just take out that most recent low in short order, then the price action is looking really bad for the dollar. Yeah. I've been anticipating some sort of more meaningful bounce in the dollar. It's yet to come. Maybe it's begun with that little pop that we had yesterday. Jury's still out on that. We have seen some bullish divergences, in the momentum indicator, where we were making lower levels in spot price, and yet the momentum wasn't as weak. So that signals maybe we have got some room for the dollar to stage a bounce. I mean, even if we bounce towards 92 on the DXY, arguably that would be enough, and we probably would meet some resistance there. Because if you look, that was a historical support level, which is now broken. So that means on the retest up, that's going to become resistance. So I think 92 would be a good place. If you did go tactically long dollar here, if we bounce to 92 on the DXY, that's probably a good place to take profits. But if we break to the downside and we go to a slightly longer term chart, there's big support around this 89, 88 area. If that gets taken out, go to a weekly chart, then, you know, longer term outlook for dollar is pretty bad. Yeah. So next stop is in that region of kind of 82 to 84 in DXY. So it really does need to hold this 88 level, right? More medium term. Otherwise, it's got kind of a good slide down towards that next target of kind of 82 to 84. I think, you know, it seems a very consensus view forming right now, that is where the dollar is headed, for a number of reasons. You know, people have been talking about, you know, the rate of change of balance sheets and things like that, and the fiscal, the US finding it easier to pass fiscal than say Europe, and you don't have these big differentials in yields anymore that you used to have with the US and Europe. So that demand for dollar has just kind of gone. So, you know, a lot of consensus positioning towards dollar bearishness. That kind of worries me. That makes me think that maybe a dollar spike is on the horizon, to squeeze out some of those shorts. But structurally, yeah, I can sympathize with the idea that the dollar's heading lower because they're going to need to keep it accommodative and keep debasing their currency and keep bailing everything out, basically. That is going to happen, but that's also true of all other countries, right? UK is going to have to continue printing, Europe's going to have to continue printing. So FX is a relative game. I think all fiat currencies are going to get debased, and that's why, you know, gold and Bitcoin and silver will arguably do well, and we'll talk a bit more about those later. But, you know, should people be quite as bearish the dollar in the next couple of months as they are? I feel like maybe that positioning is a bit overstretched. So I'm a tactical buyer. I've bought a couple of things. I'm short cable, and we'll talk more about cable in a second. I'm short cable, so I'm long dollar via that. I'm also long a little bit of emerging market. I'm short emerging market and long dollar. So I've got Brazil and South Africa against the dollar, where I've bought dollar tactically to play a bounce, because I feel a bit more comfortable playing the tactical via emerging, because they can have some quite decent beta if you get that timing right, basically. Yeah. So if we go to the pound chart, obviously the pound's been dominated by Brexit news mainly, but it also didn't help getting the lockdown news and the tier 4 news over the weekend. So that was, you had a decent gap lower in the pound. We go to a shorter term chart again. So, you know, pound got as high as 136, where they kind of thought they were going to get a deal last week. And then we touched below 132. So 4 big figure reversal over the weekend, but we've managed to recoup that and get our heads back towards 134. So in terms of the actual news flow on pound, Brexit deal still remains elusive. These fishing rights, you know, for France in particular, seem to be an area of contention, and also the level playing field. So it was looking more and more likely that we're not going to get a deal, or there might have to be another delay into next year. And obviously that's why we started to fade down. The pound started to fade lower, along with what happened over the weekend. But then yesterday, the bounce was triggered by the fact that Boris tried to reach an 11th hour deal by offering that they only cut their fishing, EU fishing catch down by a third, basically. Whereas the EU position was like they're willing to cut by 25%. So if you look at 25% versus 33%, there's not a lot between them, right? So that makes you think that the gap is quite narrow, and there may well be room for compromise where they're going to meet a deal now by the end of the month, right? So certainly on the fishing side, it feels like a deal is very possible now, because there's not that much distance. On the level playing field, who knows, right? That's not something I'm an expert in, but, you know, it seems like we're not going to get a deal before Christmas. Maybe we'll get something in the last day or whatever it is, literally on the New Year's Eve. Something to watch for. I still think even if we get a deal, so my position is, even if we get a deal at 136, a deal was pretty much priced. Okay. So I think even if a deal gets done, once we factor in the GDP hit from the stricter lockdowns, continued uncertainty on the virus front, I think any pop in sterling post the deal is quite an easy fade, right? So if we can get as high as, I think on a knee jerk, as high as maybe 138 we can get to, then I think that's an easy sell up there, to be honest, right? So that's kind of what I'll be looking to do. Probably do it via optionality, as there'll be a bit of a vol. If we get a deal, there'll be a bit of a vol reset most likely as price of volatility comes off in the pound. But structuring it that way via puts or something for slightly longer dated to give pound a bit of time to digest this news and then go back towards the economic fundamentals, which I think are pretty poor, then that's how I would kind of play it, I think. Yeah. And if you look at kind of more specifically to like the precious metals, obviously we had been talking about, I'd been trying to play a retest because I didn't think that correction was over just with that move down there. So, you know, I'd been playing a retest, and I'd said retest coming here, posted that on Twitter. We haven't seen the retest yet. It's kind of been helped by, you know, the weakness in the dollar is usually good for gold. You've also had the stimulus being passed in the US, again, usually good when they pass stimulus, more money printing, more of the same. That's usually quite good for gold as well. So gold's kind of had a bit of help from that. You know, it hasn't, if you look at that move and where it's got to, obviously intraday it popped above 1900, but then faded again. So this level at kind of 1890 is almost like, it's almost like the last stand to suggest that correction is still in play, and we need one more retest to the downside. If it convincingly takes out that 1890 level, then it may well be the correction's played out and we're heading back to the races over the next few months or whatever. But for now, I've still got some end of Jan expiry puts. Obviously, they've lost a fair amount of their premium, but now they're just kind of lottery tickets that I don't mind holding. Now, I've been using them to hedge out my existing long position that I've been holding forever. So, you know, I don't have a big issue if gold wants to fly. I own it, but I'm not looking to get rid of those puts because I think at the moment, if you own gold, you should own it with some protection. I don't think the vol's that expensive. And I do think there is a risk that real yields can back up a bit into early next year if we get better news on the virus front, which is what the market's going to be looking for. And so there is a risk of inflation, yields going up, all that stuff happening. And if that happens, then maybe gold has got one more retest to the downside in it, basically. So that's kind of how I'm going to go. Silver's done a pretty impressive break to the upside as well. Kind of similar story to gold. It's been in consolidation mode, but you know that move there kind of was threatening the idea that the consolidation might be over and we're going to start to go and retest those 30 levels at some point again. Like I say, you look at the Bollingers and the range there, like it is looking a bit high. It is suggesting that, you know, silver's kind of stretched on the upside right now. But for me, it's basically what gold does. What gold does is going to determine what silver does, I think, in the short term. Yeah, so kind of similar scenario there for me. And then the kind of last interesting thing to talk about is going to be Bitcoin. So we look up the Bitcoin chart. So I had said last week that if it takes out 20,000, then it can go to 22 pretty quick, and then maybe even 24. And it got exactly to 24, and it's kind of it's chopping around at 24, right? So you had that break, literally went from 19, took out 20,000, and then within 2 days it was like approaching 24,000. So when it breaks, it can do it violently, and it can do it in style, basically, right? So I would say now, for me, you would think any pullbacks are going to get contained by the 20,000 level. That was the big resistance level that everyone was looking at. So you'd expect on the way back down, it's going to act as some kind of support. So that would be the first level to watch for support. And then in terms of the upside, you know, clearly sky's the limit on this thing, but I feel like over the next month or so, for it to get through 30,000 is probably the next big hurdle, right? So I would expect it's a wide range, right? But I would expect the next month for it to kind of chop around relatively volatile fashion between 20,000 and 30,000 as it finds its footing, basically, as it finds its feet, right? But I don't have an immediate strong view on where it goes. If it goes down towards 20,000 and does test that support, I'd probably be looking for ways to express a bullish view. I mean, I've been accumulating outright I've been accumulating Bitcoin and Ethereum since May. So I'm not planning on liquidating those. I can stomach the volatility because I've sized those appropriately, and they are a 2 to 5 year trade in my view, basically, that I've allocated a certain percentage of my assets to those, and they're staying in the book until we go 5x from here at least, basically, right? So I've got no rush to get rid of those. But periodically, when we get pullbacks and this thing is in a strong uptrend that I continue to believe in, then I will add exposure to, on those dips, I'll add exposure via option structures. So I'll be looking at call spreads, call ratios, whatever I can to get some upside exposure that gives me a bit of extra participation if we get those rallies, basically, right? But right here, right now, my conviction of a rally in the super short term has dropped because we've already had that little break. So I think we need to consolidate from that break, and then I'll look to potentially re-enter there. Yeah, so I did have some call spready, ratio-y structures that expire on Christmas Day, and I took them off last week when we got that break, basically. Yeah, so I managed to monetize a bit of that premium. Yeah. And then when we said Ethereum's kind of been underperforming a little bit on this. So if you look at the spread between Bitcoin and Ethereum, it's kind of retesting the lows here. So in that latest break in Bitcoin, it's been pretty localized to Bitcoin. Ethereum hasn't really participated in the same way as you would have liked to see. So, you know, two things can happen. Either this chart breaks down and you actually see a continuation of that underperformance, or you say, well, this has been tested twice and bounced off there quite aggressively. So if I'm going to be long Bitcoin, I'm better off just buying Ethereum because that's got a catch up in it, basically, right? So it depends on what your view is on this chart. I mean, really, I think you want to add a longer term fundamental view on what you think about the story of Ethereum and DeFi. But if you look at a longer term trend here, there is a bit of an upward sloping trend line that you can draw that suggests, you know, we're looking a bit low in terms of that sort of spread, right? So, I mean, if you think the DeFi story is going to gather pace next year, which it most likely will, then Ethereum's got to catch up in it for sure. When I say a catch up, this ratio going from 0.26 to kind of back to those highs is looking like what, a 20% outperformance or something like that, right? So very possible. Something to keep an eye on for sure. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.